even inside of the perfect storm industry of, say, airlines, there's going to be one or two airlines that are able to gain market share over and against weaker competitors. That story will play itself out across every industry. Hello, this is Jim Lowell, and I'm Chief Investment Officer at Advisor Investments. I'm here with another Advisor You Can Talk To podcast. I'm joined by Dan Wiener, Chairman of Advisor Investments, and today we're going to talk about coronavirus reopening risks and opportunities. Before I begin, let me reiterate our sympathetic understanding of the real economic and human toll this virus has taken on a global scale. But while these remain scary times, there are glimmers of hope for better times to come. And meantime, through the best and worst of times, Advisor Investments has been here to serve you. And we remain fully operational and committed to helping you manage current events wisely and well so that you can better secure your financial future. Dan, I just mentioned a glimmer of hope, and I think reopening falls under that category. And we've been discussing the eventuality of reopening in theory for several weeks, but now we're beginning to see it in practice. How do you think the slow reopening of some businesses will affect the economy overall?
Well, thanks for giving me an intro here, Jim. I think slow is the operative word. And I do think that for the next couple of weeks, we're going to have to keep a very close eye on how the number of cases of coronavirus either increase or decrease in the areas where this reopening is happening. A lot of mom and pop businesses have been closed for good, others are. Pivoting in some ways, and to restaurants have become distribution points for food, either cooked or raw, that people can pick up, contactless pickups, and take home and cook. It's really a big question about whether this reopening, are people going to go to barbershops? I know a lot of people are talking about wanting to get their hair cut, but are they really going to be uh, going in, and is it going to pay for these businesses to reopen? We know that a lot of large businesses are not reopening at all. They are going to maintain a closed posture until they see what happens here. Um, it's a big question for this country because half of all people who have jobs in this country work for small businesses. Small businesses defined by the Chamber of Commerce and the Small Business Administration as those with under 500 employees. 99.9% of businesses in the U.S. are small businesses, and they're responsible for 60 to 65% of net new jobs each year. If these mom and pops and small businesses under 500 people stay closed for a long period of time, we're going to be, uh, we're going to see more slowing in the economy. We just got the report this morning on GDP having fallen at a 4.8% annualized rate in the first quarter. I don't think those numbers mean a whole lot. We it was the worst quarter since the fourth quarter of 2008 when the economy dropped at an 8.4% rate. But I think we're going to see a much bigger drop in the second quarter. And also, I think people have to remember that the economy is about 20% larger today than it was back in 2008. So um, I'm not sure that we know a whole lot about how the economy is operating right now. And I think that reopening is going to be a very small piece of it at the moment. I don't know. What are you looking at, Jim? What are you watching for in terms of a real sense of recovery here?
Well, I think you hit on one of the key components, and that's the jobs condition right now. Obviously, the condition is dire, so we'll look for any kind of improvement, but we're not necessarily hopeful that we'll see that, as you said, in this quarter. It may actually take several quarters, especially for some industries that are specifically in the perfect storm. I'm thinking of travel, leisure, things, industries like that. The uh, the overall sense in terms of a sustained recovery, will be delivered, and we've talked about this often, by means of more reliable medical data, first and foremost, that helps substantiate the hope and beyond the hope that we really have turned a corner for the better. And while there are hopeful signs that tentative small scale reopenings may begin in greater succession, they've already begun in sort of piecemeal fashion. And while the market is clearly traded on that hope, I mean, we've already had a very significant recovery off the bottom, based, I think we'd argue, on hope, not on fundamentals, because as you pointed out, the fundamentals are oblique at best. Our portfolios have participated in that rally to a meaningful degree, but we'll remain data driven, cautious, prudent in our approach, and I do think that the Fed stimulus, global stimulus, provide a safety net underneath the global economies. But we've often discussed the fact that they're issuing more, not less, stimulus for a reason. That reason suggests we have a ways to go in ensuring that the net itself is wide and strong enough, let alone capable of supporting a sustained recovery. And meantime, we're certainly looking at earnings. They continue to stream in, but like the economic data that you mentioned is being murky and unreliable at the moment. The consensus view among earnings is that there really is a lack of any sort of clear view. Though there have been some positive surprises. Costco, Johnson and Johnson, for example, really upbeat notes. I'd say we're seeing key East and West Coast states and counties delay their stay at home mandates by a few weeks or more based on their lack of clarity as to whether the flattening of the curve has been achieved and will stay flat to hopefully descending. Probably should note the reopening is a vague term, subject to a moment's notice, a moment like a probable recurrence of the virus, as you noted, inside states, counties, maybe even countries that reopen too much too soon. And the shock of seeing reopened states reclose is something that I don't think the market is priced into current levels.
No, I think the market actually, I think those who haven't sort of kept track of this on a day-to-day basis would be shocked to learn that the S&P 500 is only down about 11% for the year. I mean, it's human psychology to sort of take a look at where things are from the peak. And of course, we're down 15%, 16% from that February peak in the market. But if you just look at the year to date, an 11% decline for the S&P, this is your typical retrenchment. Just something on average you see every year, intra-year.
I completely agree. And for clients and advisors and others who are in disciplined, well diversified in terms of assets, stocks, bonds, cash portfolios, they're likely faring significantly better than that. Likely not even in correction territory, which would be down 10% for the year. And we certainly see some sectors actually return to positive returns. I'm thinking of the healthcare sector and the technology sector as well. I would say that all gains from the lows remain vulnerable to a second wave of the virus. The recurrence, of course, of the virus in the winter flu season is basically locked in. Societal disruptions, economic hardships, they're going to be ongoing, unlikely to abate in the months to come. But we're fully cognizant that we don't need to wait for all states, all countries to reopen before we take any meaningful new investment step. But we definitely think that the most meaningful economies and the most meaningful states, that would be East Coast, West Coast, that really drive economic activity, are the ones that we'll be watching most closely.
Yeah,
Um,
we're starting to get some economic data in for the first quarter. Obviously, I talked about GDP numbers for April. I think it's very important for folks, and given the recovery that we've seen so far in the stock market, I think it's very important for folks to not read too much into data for the first quarter. We really remember that the first quarter encompassed January and February when we were reading about some sort of virus over in China, but we didn't know that it was already here. Um, you know, I think we have much more to come. We've seen claims for unemployment. The last 5 weeks, 26.4 million people have filed for unemployment. We've seen the government jump in with lots of safety net programs to try to ease that pain. But I think that, like you said, we have to watch these reopenings very, very carefully. Um, the first bit of data we're getting really just sort of sets a baseline. I think uh, where are we from the initial shock, and then how do we go along from here? What do we know? What are we going to need to know? How are hospitals going to be prepared for, as you said, maybe a resurgence or reoccurrence of the virus either in the fall or more, closer to the date of these reopenings, if we do see blooms occur again. Um, I think we got a very late start, but I'm hopeful that you know as we've ramped up production of face masks, of respirators. I see that a number of biotech companies and pharmaceutical companies have recently said they have really rushed uh, their testing of new antiviral medicines along, and maybe we will get the first glimmers of hope for some kind of vaccine before the end of the year. But I think we have to remain cautious here.
I would completely agree. Caution's the byword, prudence, patience, the approach. And I think you're also right, Dan, that we're beginning to get a better sense of where we've come from. Over the next quarter or two, we'll get a better sense of where we are in terms of economic earnings data. And that will help better frame where we think we're going. Ultimately,
I
we
think the
take, go ahead.
no, I was going to say that the media is sort of overwhelmed, of course, with all the losers and people losing their jobs, companies losing business, uncertainty about earnings. But let me throw this at you. There going to be any winners here in this pandemic? I mean, I say that with caution in my voice. I mean, nobody wins, but we are investment guys. We're not social scientists. We're not doctors.
Right.
We are looking at this from an investor's point of view. Will there be winners in this to come out of this pandemic?
Oh, there absolutely will be. Even inside of the perfect storm industry of, say, airlines, there's going to be one or two airlines that are able to gain market share over and against weaker competitors. That story will play itself out across every industry's board. It's going to be a market for investors in which active management, active acumen, good information, better analysis, better execution, the kinds of things that the managers we invest in right alongside of our clients are known for, are going to be able to deliver into the marketplace. Will be able to benefit from that kind of intelligence. I think maybe I'll take healthcare, and maybe you can take technology as two areas that, as I noted, they're already beginning to show relative strength and even absolute strength in terms of a return basis. Healthcare stocks obviously have a lot going for them, besides the long-term demographic trends that we talk about often, because we have been overweight the healthcare sector, not just for weeks, months, or years, but decades at Advisor Investments. The necessary demand of aging populations, but you've also got the short term boost here because of the crisis, the demands that are created by this pandemic. And those aren't just necessarily inside of the healthcare industry. We saw 3M, a manufacturer of masks and gloves, having some spectacular demand for dramatically dire conditions for its product lineup. We're going to see that play out across the board. And then, of course, healthcare stocks overall have a great long-term growth trajectory. As well as the global economy returns, so will the demand for more and better healthcare services, not just here in the US, but globally. One of the surprises, though, I would say, Dan, to us is long-standing, long-term investors who've gone through many bear markets, many recessions, is that in past recessions, typically the highest flying sector was the one that got beaten up the most. And yet this time around, technology was clearly the high flying sector, and it still has wind underneath its wings.
Yeah, there's a whole host of companies that are doing well during this pandemic. Obviously, there's been a shift to greater and greater use of cloud computing, um, all sorts of new technologies. I mean, the technologies that you and I and the 95 people in our company are using to stay in touch, to keep our business running on a day to day business, to be in touch with each other, with our clients. I mean, we all use video phones and Zoom technology so that we not only can talk to one another, but see one another. Um, you know, there's a lot of questions down the road as to who will benefit from this. One person that I was talking to said, it could be that electric cars see a big boom down the road. Why? Well, partly, I mean, right now with oil at $12 a barrel, it's pretty cheap to fill your tank up, but you do have to go to a gas station. You do have to deal with a pump. You don't know who picked up that handle the time before you, whether they were sick or not. I think people are going to be a little more cautious about going literally to gas stations to pump gas. And they might just say, you know what? I'll buy an electric car. I can plug it in at home and I don't have to deal with any of these gas stations and not knowing who's been there before me. So on the technology side, a lot of companies are going to pivot to doing more work from home. Their people are going to get equipped so that they can work from home and not have to go into the office every day. Um, there are a lot of structural changes that I think we'll see in the economy going forward. A friend of mine has a company called Let Us Grow. Lettuce is spelled the way the vegetable is, and Let Us Grow is selling natural hydroponic, grow your own vegetable devices that you put on your deck or you put on your backyard, any place that there's some sun, or you can use grow lights. And I think they're around $500, and these things water themselves. You only have to maintain them, I think, for a minute or two a day, and what they're producing is just incredible. Fresh vegetables right in your home. This is going to be something else that I think uh, people are going to shift to. They're realizing that the supply chains can sometimes be broken. If the supply chain's broken, why not?
I love the optimism, Dan. And as we wrap up this advisor, you can talk to podcast. Clearly, there are a lot of unknowns in terms of both the risks and opportunities that reopening presents, but it does provide that glimmer of hope that we will be able to, over a period of several months, perhaps a year or more, return to some semblance of normal. But in the meantime, there are clearly some risks that we will hope to be able to manage well, and also some investment opportunities that are being created by this crisis. And with Dan, with that note, let me shift tone and gear. And you've been a music lover all your life, always sending great suggestions to listen to, from hard rock to jazz to blues. In these discordant times, can you give us some upbeat playlist favorites?
Oh gosh, that's fun. That's great. That's a great way to end this podcast. Sure. Let's see. I am a big fan of a blues singer and guitarist named Keb Mo. His actual name is Kevin Moore, but he goes by Keb Mo. His songs are fun. The musicality is fantastic. I really would recommend that. I've also anyone who has known me for any length of time knows that I've been a big fan of Pat Metheny's for years and years and years. I remember watching him in concert back in the 80s, the 70s in Boston. Pat Metheny is an incredible guitar player. So anything that he has done is worth listening to. And I just was sent a link to the video of the 1985 singing of the We Are the World song that was done to support Africa. The Michael Jackson put this thing together. But if you go onto YouTube and search for We Are the World, it's pretty incredible to watch all these singers come together all in one room, all the best of the best, Bob Dylan and Bruce Springsteen and Ray Charles and Stevie Wonder, all singing together, talking about hope and worldwide peace and health. So uh, those are three I'd go for. And so, you know what? I'm going to throw it back at you, Jim. Um, I know that you are a fan of film and film history. So why don't you give our folks a couple of ideas on things they could either watch or read during these times?
Let's see, Dan, to chase the coronavirus blues away, even though I know that's no time for joking and what we're living through is as rough as it gets. Let's see, sometimes you can fight fire with fire. So, Soylent Green, the Andromeda strain, would fit that approach. More lighthearted, You Can't Take It With You. That's a zany divided house unites in the end through love, a movie from, I think, 1938. Singing in the Rain, which is interestingly a meta reflection on disruptive technology in the disruptive transition from silent movies to sound. Those are good thematic choices, I'd say. But on an uplifting note, if I reach into my movie magic hat and pull out one must see, it's the light-heartening madcap switcheroo classic called What's Up, Doc? That movie still makes me laugh out loud, no matter how many clouds there are in the sky. And on those uplifting notes, this has been Jim Lowell and
Dan Wiener.
from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe and review our show. And you can check us out at advisorinvestments.com/podcasts. Your feedback is always welcome. And if you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. Thank you for listening and stay healthy.